Hey traders, Jason here from Leavitt Brothers. Happy Wednesday. 3 weeks ago, when I did my last State of the Market video, I stated if the market wanted to piss off the most number of people, it would just keep pressing higher. Wannabe longs would not have a chance to get in, and shorts would get squeezed. This is exactly what has happened. In fact, since that last video, the S&P has posted a gain 12 out of 15 days and has added about 125 points to the move that started after Christmas. So that's not bad. Here's the weekly S&P chart that I'm closely following, or I guess you can say I'm following it as closely as you can possibly follow a weekly, given that only one candle forms every week. To highlight a few things here, you can see that the 50 acted as support here. The 50-week acted support here, with support here, kind of resistance here, but we're right up against the 50 here. Okay, and then the 200-week moving average, which comes in here, was support and was support at the December low. So both these moving averages, the 50 and the 200 on the weekly time frame, have been very much in sync with the price action. Okay, so this is a key level right here because the S&P is right up against the 50. We'll have to see how it navigates this. Can it really bust through given that we've gone up this many weeks in a row? Tough to say. At the very least, we need to be a little bit more cautious here, at least aware that this moving average exists. Here's the daily chart. Okay, I'll highlight a few things here. So the 200-day was support here. It's kind of ignored here, but the index is right up against the 200-day right now. The daily hasn't always been in sync with the index. You got a little bit of resistance here, some support here, a little bit of support here. This seemed like an inflection point because when it got through that level, it dropped hard. A little bit of resistance here. For the most part, it hasn't really been in sync. The 200 has been much more telling. So it's just something to keep an eye on. That on the weekly chart, we have the 50 up here. On the daily chart, this one that you're currently looking at, we have the 200. It's something to keep in mind. The market's done incredibly well. It's rallied a lot off the lows, but now we're moving into a key level. All right, so now I want to check out the internals. Okay, what are they telling us right now? Are the gains that we've had over the last month supported? Are there any warnings? Okay, let's see. That's what we're going to do today. Okay, so here's the S&P 500 up top. The 10-day of the AD line is in the middle, and then the regular advanced decline line is down below. All right, so the first thing I want to point out is that when the market is really healthy, as it was at the end of 2017, beginning of 2018, you tend to get prints like this, mostly above zero. When the market does well, but is not doing incredibly well, you get prints like this, mostly above zero, but you get some dips below zero. And then when the market's not doing well, you get these big dips below hand. So you can see the I don't want to say cascading rectangles here, but you can see when the market does well, you get the prints up here, drop down when the market does well, but not incredibly well. So right now, obviously, we're getting these prints up here, which is really, really good. I mean, we haven't had steady prints up here in a really long time. So from this standpoint, the market is doing incredibly well. In order to support a continuation of the trend, we just want this to continue. Okay. In fact, it doesn't even have to continue at this level. It can continue just up here. And in fact, we'll even give it a little bit of a leeway and say it could even drop down below zero on occasion. Okay. So as long as we get some steady prints, kind of like this, the market will be well supported and the uptrend is going to continue. Okay, so this is a really good indication right now is what I see. But I should point out that we're getting a negative divergence here. Okay, so you could see higher high with the index, lower high with here. In the past, low divergences have led to little pullbacks or at least pauses. Okay, we got a divergence here, which led to flat trading, and then eventually the market fell. You can see back here, March last year, you got a divergence there. The higher high with the market, lower high with the indicator. Same thing over here. Okay, which led to a fall drop there. This was a little divergence, although not much. The highs were basically matched while this moved up. Okay, and that led to basically flat trading over the following couple of weeks. Okay, so this divergence is pronounced enough that it's something we should kind of keep in the back of our mind. Okay, it's taking place at a high level, which I like. okay, but it's still in place. So when you look at a divergence like this, when you consider that the indexes are up against their moving averages on the last two charts I showed you, it's at least a reason to be a little bit more careful with initiating new positions, and play it a little bit more defensive. The advanced decline line is in great shape here. This is the overall advanced decline line. It's doing really well. It's rallied all the way back. It's almost matched its highs. If it would have gone like this and kind of rolled over and been struggling, then I'd say, hey, the market's not really being supported. But the fact that it went up all this way tells me that the market is well supported. One scenario that I'm kind of looking to play out, possibly, no guarantees, is that if indeed this divergence causes the market to pull back a little bit, what if this kind of pulled back, got scooped up by its 50, and then headed up again? Okay, it's just something I'm keeping in mind. But overall, this looks good. Divergence tells us to be a little bit more careful in the near term. Here's S&P 500 up top. New highs in the middle here is what I'm focusing on. Like the last chart I showed you, when the market is doing incredibly well, you get new highs at a high level. When the market is doing well but not incredibly well, you still get steady new highs. Obviously above zero, they can't go below zero. And then when the market is not doing well, you get mostly prints down here like under 50. Okay, so recently, the new highs popped and are up here, which is good. This is exactly what you want to see. Okay, if new highs can roll up and down in this box that I just drew, the market's going to be supported and the indexes are not going to fall much. Okay, you get dips, that's fine. You get little corrections, it's fine. But as long as new highs print up here, market should be in good shape going forward. We'll see what happens, but this is what I'm looking for. Okay, another look at new highs. This is the high-low differential, so it's highs minus lows. You can see the cascading windows here. Again, just to reiterate what I just said, we're looking for prints here. If we can get this indicator to roll up and down, mostly above zero with occasional dips below zero, the market will be in good shape. Okay, you're just when new highs are beating new lows consistently, the market's not going to fall that much. It's just not going to happen. One more chart of highs and lows. This is the high-low differential. It's the cumulative. Okay, so I want to point out how this indicator is acting relative to how it's acted in the past. Okay, as you can see, if I go back to 2015 here, you can see the indicator moved below its 50-day moving average, just like it did here. This is one of the reasons I turned bearish end of September, beginning of October. I did it in video several times, talked about how this was declining and putting space in between itself and the 50. So you can see over here where the indicator came up to the 50, got rejected, and then moved off the 50, and this led to the market moving up, flattening out, and then coming back down. So I've been looking for that right now. Are we going to come up here, get rejected, and come back down? Or is the market just going to go through it? And we'll see. And, what happens will go a long way telling us what the next move is going to be. If this goes up and gets rejected and starts moving down and we start getting distance between the indicator and the 50-day moving average, the market's going to do the same thing. Like, I don't know if it's going to go all the way down to the bottom and test the lows, but at the very least, it's going to drop. But if it can move up above the 50, then it'll be kind of like this type of a situation where the uptrend's going to end, or the downtrend's going to end, officially end, and then the path of least resistance is going to be up. Let me show you. This is the NYSE chart. Let me show you the Nasdaq chart just to show you one other possible scenario. Okay, you can see what happened here, where the indicator didn't cross up or get rejected. It just kind of flattened out, and the moving average got flattened out, and they moved together for a couple of months, and then eventually the indicator started to move up. Okay, so it's a scenario worth considering. Okay, so one scenario is it gets rejected and it comes like this. Another scenario is it comes up. Another scenario is it just moves flat. It's just nice to be open-minded to the possibilities that are coming, and since these two are getting close to converging, something's going to happen. We're going to get some sort of an inflection point where it's either going to break out, fully support the uptrend, or it's going to get rejected and given where the indexes are relative to those important moving averages, we're probably going to get a dip. Something to be aware of. All right, next chart. Percentage of S&P 500 stocks above their 20-day moving average. Okay, when the market is doing well, you get steady prints up here, like above 50%. Okay, and you can see, I mean, you can match these up. Like when you get steady prints up here, the market goes up. Steady prints here, the market goes up. Okay, so looking here, we just need steady prints here, and of course we're getting them at a really high level, which is great. Okay, we're like more than 90% of S&P 500 stocks are above their 20-day moving average, which is just fantastic. It gives us a lot of wiggle room. The S&P itself can dip back down, test the 20 if it wanted, test whatever moving averages that it wanted. That negative divergence between the S&P and the 10-day moving average of the AD line could induce a little bit of a sell-off, but we have enough of a buffer here that this could come back down, and then there's plenty of space for it to roll up. Okay, if this was taking place over here, I'd be a little concerned, because you think like a little nudge down and the thing would drop into bear territory, but it's at such a high level that there's a buffer. Okay, the market has a cushion to work with. It could very easily cycle down, do some backing and filling, and the indicator has room to do some backing and filling, but still be in bull mode. So I would say this is incredibly positive for the market. If you're looking for signs of strength, this is it. There are no warnings here. Okay, similar chart with the percentage of stocks above their 50-day moving average. We're getting like almost 90% of stocks are up there. So, you know, and this is a higher print than any point in time in the last year. Okay, it's even higher than where it was last January when the market was up, you know, and had basically hit like inflection points like here and here, where it just kind of took off. Okay, so again, you know, all we want are steady prints up here, and obviously we're getting it. And if the market wanted to do some backing and filling, as long as we kind of stay here and eventually move up, market's just fine. Okay, the market has enough of a buffer and a cushion to work with that it could do some backing and filling. The indexes could pull back, the indicators can pull back, and the market overall is still in good shape, or will be in good shape. Let me quickly go through a few more here. So here's the bullish percent chart. When the market does well, you get prints. Like generally, you get prints like, you know, above from the low 50s on up. Okay, and obviously when the market gets into trouble, then it drops back down. So we're getting close, okay, but we're not quite there yet. Okay, and you could see if we like go back to 2015 where we got this, you know, this double bottom here, boom, boom, boom. This moved up, but struggled. It kind of got to a decent level, but struggled and eventually went back down. That's what we got to look out here. This chart is from yesterday. It hasn't updated today. But we need prints up here, because if we come up here and get rejected and it struggles, you know, we could have a repeat of what took place over here. Okay, something to keep an eye on. Most indicators are doing really well. This one is not quite there yet. It has improved, obviously, you know, from 20% all the way up to where it is right now, which is near 50%. But it needs to improve some more, and it needs to get permanently above 50% and it can't get rejected by that level. Next chart, and I realize this is a small one. In green here is the percentage of S&P stocks at a 20-day high. Okay, so you get like, we got a little bit of a range here like this, and then you can see the indicator broke out here, came back down, tested, and then moved up again. Really good action here. Okay, so again, the strength is pretty broad-based. You're getting a lot of participation. It's not as if you have a handful of big companies that are masking weakness, you know, beneath the surface. This chart tells us that there's a lot of stocks that are participating, that are at 20-day highs, and as long as this continues, the market's not going to fall. Okay, if you have this many stocks at 20-day highs, the market isn't going to fall much. It could do some backing and filling, that's fine, but it's just not going to fall that much. Okay, so overall, the market is done. And is doing incredibly well. The 10-day AD line is printing at a healthy level, and the cumulative AD line fully supports the gains. New highs have moved up. The percentage of stocks above their 20 and 50-day moving averages are at high levels. Percentage of stocks at 20-day highs, has broken out and is sitting at a high level. On the flip side, a negative divergence is forming between the S&P and the 10-day AD line, and the S&P is right up against its 200-day moving average on the daily chart and the 50-week moving average on the weekly chart. So overall, the market is doing fine, but in the near term, I could see maybe a little bit of weakness materializing. At the very least, we need to be a little bit less aggressive with new trades and adopt more of a defensive posture. Okay, so again, overall, I think things are doing well. I think the market moves up higher from here, but in the near term, we got to be a little bit more careful. All right, thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content when it's posted. Come check us out at Leavitt Brothers. If you're not getting the results you want, change something. Okay, change the types of trades you do, change how you do your research, where you get your ideas from. Try different things until you find something that works. Okay, check us out at Leavitt Brothers. Perhaps we can be the key ingredient that gets you over the top. Again, thanks for listening, and I'll see you next time.